I've helped over 3,000 traders reach profitability and build thriving careers, making $3,000, $5,000 per month, $10,000, sometimes upwards of $50,000 in a single month. And I've done this for hundreds, if not thousands of people. So it's safe to say, I know what you need to do to win. And in this class, I'm going to share everything that you need in order to reach the same levels of success as my students. So without further ado, let's get started. So first of all, what is Forex? Well, Forex is simply an abbreviation of foreign exchange. And foreign exchange is the name given to the largest financial market in the world, where we trade the value of different currencies. So if you're familiar with stocks or shares, as they're the most common, it's similar to the stock market. But instead of buying shares in a company, we are instead betting on the value of different currencies against other currencies. We'll get to this very soon. The foreign exchange market is the biggest financial market by far, with a daily turnover of more than $7 trillion, which means every single day that the market opens, $7 trillion passes hands between banks and individual traders like me and you. And there are two key players in the Forex markets. We have institutional traders and we have retail traders. So these are the different participants. Institutional traders are by far the biggest. They make up around 95% of the overall trading volume. And these are traders like banks, hedge funds, trading firms, and large players like that, with hundreds of millions or even hundreds of billions of dollars to trade with. Now, the little guy, me and you, we are retail traders. We are just individual people stepping into the market, hoping to take some positions and make some money. We have no bearing on what the market actually does because most of the movement is created by the big banks. But that doesn't mean there isn't opportunity somewhere in that $7 trillion for us to step in and make a good living. And that is exactly why we trade the market. We are just looking to take good bets inside of the market, take some good trades, and make some money at the end of each month, quarter, and year. So how exactly do we make money then? Well, when we're trading the market, we are essentially making bets. So sometimes we're going to be right, sometimes we're going to be wrong. It's kind of like gambling, but we have a significant edge that we can build into trading that guarantees that we win long term. Now, what we have to do in order to make money is either buy or sell a market before it goes up or down. So if we bought a market and it went up, we would make money because we are buying a contract now, selling it back later after it's appreciated. Now, obviously, if we buy and a market goes down, we would lose money, which is where the losses come into the equation. But don't worry about losses. We control those. It's all part of the strategy. Losses are completely normal. And I'm going to show you before this class is over how to control the losses and create that positive balance so that you can ensure you win over the long term. Now, what do we actually trade in the market then? Well, as we said, we are trading currencies. We're not trading stocks, we're not trading shares, we're not trading cryptocurrencies or anything of the like. We are trading the value of different global currencies. So things like the pound, the US dollar, the Australian dollar, the New Zealand dollar, the euro, or the Japanese yen. That is what we trade. But in the Forex market, we are not actually buying and selling physical currencies. We buy something we call a contract for difference, or a CFD. What a CFD is essentially a bet on whether one currency is going to go up against another. And every trade that we take in the Forex market includes two different currencies, which make up the very assets that we trade, called currency pairs. So what is a currency pair? Well, a currency pair is a collection of two different currencies. In this example, we have the euro and the US dollar. And with this example of Euro USD, if we were to buy this asset, we would be expecting the euro to go up against the US dollar. And we would make money if the euro went up against the US dollar. Now, Euro USD is far from the only currency pair that we can trade. There are actually probably over 100 different currency pairs to choose from. They're broken down into three subsections. We have major currency pairs, we have minor currency pairs, and we have exotic currency pairs. Now, majors are the ones that you would want to trade, and these are made up of the major global currencies. They are the US dollar, the euro, the British pound, the Japanese yen, the Swiss franc, the Canadian dollar, and the Australian and New Zealand dollars. Now, major currency pairs are always weighted against the US dollar, as this is the world reserve currency right now. So it's the most important currency in the world. It's the currency that different countries trade in internationally. So some examples of major pairs would be Euro USD, GBP USD, AUD USD, NZD USD, USD JPY, and USD CHF. My suggestion to you is that you focus in on these major pairs only. You don't really need to be trading minors or exotics at this point, or really at any point in your trading journey. Now, just to briefly cover what they are, minor pairs are major global currencies disregarding the US dollar. So these would be pairs like Euro GBP, GBP JPY, Euro JPY, or GBP AUD. And exotic currency pairs are made up of the US dollar, along with developing or emerging world currencies like the Hong Kong dollar, the Singapore dollar, the Mexican peso, or the Swedish krona. So you know what they are, but I still highly recommend that you just focus on major pairs. Now, to explain currency pairs a little bit deeper, let's go back to the Euro USD example. A currency pair is made up of two different currencies. We have the base currency and the quote currency. The base currency is always the first currency in the pair, and the quote is always the second. Now, the base and the quote make up the price. And basically, the price of a currency pair will be the value of one base currency versus one quote currency. So if the price of Euro USD was 1.112, that would mean that 1 euro is equivalent to 1.112 US dollars. That is the price of that currency pair, and it is the difference in value between the euro and the dollar. In the example of USD JPY, which is the dollar versus the Japanese yen, if the price of this currency pair was 144.05, that would mean that 1 US dollar is equivalent in value to 144.05 Japanese yen. So the price is always the value of the base currency in the quote currency. So now you understand the very basics of what the market is and what we actually trade in the market and how we make money. But why do we choose the Forex markets over other markets such as stocks or cryptocurrencies? There are a couple of core reasons that, when we bring them together, make Forex the best market to trade for individuals like me and you. The first is liquidity. Now, as we said, this is the biggest market in the world by far, which means that there's a lot of money flowing around. Now, liquidity simply refers to money, how much money is flowing around a financial market. If liquidity is low, sometimes when you get into a trade, your entry will be way worse than you wanted it to be, which gives you a bad price and means what could have been a winning trade is going to become a losing trade. The same can happen for getting out of trades. If you're trying to get out in profit, but there isn't much liquidity in the market, you're actually going to get out at a worse price. So the first is liquidity. You have more liquidity than stock and crypto markets, which means you never get caught in these bad trades. And the second, and probably the most important, is the flexibility. So crypto markets are arguably the most flexible because they're open 7 days a week, but they have liquidity problems and your trading conditions are not going to be so good. You'll have to pay large commissions, your entry and exit prices aren't going to be brilliant. But in Forex, we get great liquidity plus almost as much flexibility. See, Forex markets are open 24 hours a day, 5 days a week. So they do close for the weekend, not quite as flexible as crypto, which is a 24/7 market. But anytime there isn't Saturday and Sunday, we can trade actively in the Forex markets, which makes it a great market to select. We're not confined to specific trading hours like we would be trading the stock market. So those are the big two reasons. It's flexible and we can trade at pretty much any time we want, but it's also more liquid than the other markets, which means our trading conditions are better, and the odds of getting caught in those horrible trades that you just can't escape is massively, massively lower, pretty much non-existent. There's also a few other benefits of trading these CFDs and trading Forex that you don't get elsewhere. The first is the opportunity to go long and short. Now, to cover a bit of terminology here, a long trade or a long position is simply a buy. So if I say I'm going long on a market or I'm long on a market, that means that I'm buying or I've already bought a market. Short is the opposite. It's a sell. Now, what we can do with CFDs is actually sell before we buy. Now, I know this sounds weird, maybe a little bit confusing, but it's actually very simple in practice. We sell a contract with a promise to buy it back later. So if we sell the contract and it goes down, we can buy it back cheaper, we profit from the difference. When you buy a physical stock, you can't do this. So you can only profit from markets that are going up. Markets don't go up all the time, but in Forex, we can benefit from the declines as well. So if a market is crashing, we can short, we can sell it, and we can profit from that down move. If you hold physical crypto, the only thing you can do when the market declines is lose. But in Forex, we can win, even if the markets are crashing. So to boil down why we choose Forex over other markets, it's more flexible. We can trade it both ways. We can trade it pretty much any time we want throughout the week. And because of the liquidity, we have the best trading conditions and the lowest costs for trading, meaning the commissions for getting in and out of trades are sometimes zero, but always very low. Throughout this class, you're going to hear some terminology that might be completely new to you and might be confusing. But don't worry, because anytime I mention a jargon term, I will be covering it and explaining exactly what it means. So the first one that I really need to explain now is the concept of bullish and bearish. So bullish and bearish are words that are given to directions in the market or biases around the market. Now, a bias is simply which way you think a market is going to go. So if you think a market is going to go up, or if a market is already going up, this is called a bullish market. You would say, I'm bullish on the market if you were in a buy trade, or you thought the market was going to go up. You would say Euro USD is bullish if it was already going up. Bearish is the opposite. So if you thought a market was going to go down, you'd say, I'm bearish on this market. If Euro USD, for example, was already falling, Euro USD would be a bearish market. So these are terms that you need to know because you'll hear bullish and bearish quite a lot. Now, the other thing I want to mention just real quick is my use of the word position. A position is a trade, and a trade is whether you've bought or sold a market. While you are holding a buy or a sell, you are holding an active trade, you are holding an active position. So just to get that out there, let's move along. In the Forex markets, because they are flexible, there are many different ways to trade. The three main trading styles are swing trading, day trading, and scalping. Swing trading is long-term trading. Trades that are held anywhere from more than one day up to weeks or months. Day trading is trading that takes place within a single day. So a day trader will look to get into and out of their trades in a matter of minutes or hours. Scalping is very, very low time frame work, where you look to get in and out of a trade in a matter of seconds or just a few minutes. Now, all of these different trading styles can be viable and can make you a profitable trader. And most beginners are drawn towards day trading or scalping because of the excitement. But I'm going to tell you now, the easiest way to win as a trader is swing trading. This is the fastest way to escape your 9 to 5. This is the fastest way to build up trading capital and the easiest, most passive and least time consuming way to build a career in the markets. So I would suggest you stick with swing trading to begin with. You can always scale down and learn day trading and scalping later. Okay, so we know to make money, we need to be moving with the market. But to move with the market, we need to know whether the market is bullish, going up, or bearish, going down. And we call these up or down movements in the market trends. Markets move in three trending phases. We have uptrends, where a market is going up. We have downtrends, where a market is going down. And we have consolidation, where a market is going sideways and not really doing much at all. Now, obviously, our plan is to go long or buy in uptrends, go short or sell in downtrends, and stay out of the market during consolidation. When the market's going sideways, we do not want to be involved. This is where a lot of money is lost. But how exactly do we know which way the market's going to go? Because we can't see the future, right? Well, we work out which way we think the market's going to go and place our bets accordingly by using analysis. Now, analysis is just methods of reading the markets to see which way we think the directions of different currencies are going to go. There are two core types of analysis. The first is technical analysis. This is where we use price charts to determine whether a market is going to go up or down. Now, I'm going to teach you all about these price charts, what they show, what they mean, and how to trade them, as well as give you a strategy you can use a little bit later on. Fundamental analysis is the second type of analysis. This is where we use real-time news, data, economics, and political information to work out what's likely to happen in different currency markets. Fundamentals are brilliant, but they're not very beginner-friendly. It makes a lot more sense to focus on the charts because you can succeed with charts alone. So in order to not massively over-confuse you, in this class we're going to be focused on technicals. There will be opportunity to learn more about fundamentals later, but today we're going to focus on the charts. So when it comes to technical analysis, our goal is to build a strategy, which is going to be a list of rules that we can continually apply to price charts in order to work out whether the market is going to go up or down. I'm going to show you a strategy very soon. But in order to be a winning trader, analysis alone is not enough. Earlier on, I told you that we are going to win and we are going to lose. So some of the trades we take will actually result in lost money. Trading is not a linear game, meaning we cannot win every trade we take, and we will never see our account balances and profits just going up like this. We're going to have ups and downs in this market. That is just the nature of trading. Now, one of the greatest traders of all time, Peter Lynch, said this famous quote: "In this market, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. Now, keeping that in mind with what I've said, we obviously then need a way to balance the wins and losses. And that is where risk management comes in. Well, risk management is the process of holding your winners for as long as possible to maximize the profit you take on winning trades, and cutting your losers as fast as possible to make sure the losing trades you take are considerably smaller than the winners. If you do this consistently, your winners are going to bring you back a lot of profit, while your losses will only cause you a small amount of lost money. We balance big wins with small losses, and guess what? We make money long term. So if you've seen anything about trading before watching this video, you might have seen the very cliche but 100% true and relevant term, cut losses short, let winners run. That is the process of risk management. So there are two main types of edge that we can create. An edge is basically our ability to make money consistently by weighing probabilities or odds in our favor. And the two types of edge are win rates and risk to reward. Your win rate is how many trades you win versus how many trades you lose. So we know that the average win rate is going to be around 50 or 60%. Now online, people will try to sell you a dream. Do not listen to people telling you they win 9 out of 10 trades consistently. It doesn't happen, I promise you. Now, because we know we're not going to win every trade, we can't really build an edge with win rates in mind. So if we have to rely on winning 7, 8 or 9 trades out of 10 in order to be profitable, we're not going to be profitable for long, because when we hit a losing streak, we're just going to lose all the profits we've made. So the other type of edge, and the one that I massively suggest to you, is a focus on risk versus reward. Risk versus reward is a concept where you try to make more money on your wins than you lose on your losses. So a risk-reward ratio will be a number like this, 1 to 3. In a trade with a 1 to 3 risk-reward, we would be risking $1 to make $3 or more back in profit. This means if we only win half of the trades we take, we're still making a significant profit, because every time we take 10 trades with $100 risk, for example, we win 5 trades, which would be a $1,500 return. Then we would lose 5 trades with a $100 loss per trade for a $500 loss. So with 5 wins and 5 losses, we come out with $1,000 in profit. Now you can see if you consistently do this over the long term, you're going to make money even though you're wrong half the time. When you trade with a risk-reward edge, you don't have to worry about being right on every trade. You can just weigh the probabilities in your favor, trade without stress, and come out on top, even when you take losing trades quite regularly. So here is a Monte Carlo simulation, which is basically just a portfolio predictor. You can see this one-to-one trader with no risk-reward edge is pretty much doomed to fail. The only way he can win is by using luck. But this trader with a risk-to-reward focused edge makes money long-term, even when they're wrong half the time, as you can see, because when they win, they're winning significantly more than they lose. So now you know the basics of trading, and you know what it takes to win. We've talked about analysis and risk management, and pretty much how you collate a strategy that's going to give you an edge and allow you to beat the market. Now we can go a step further and start talking strategy. But quickly, before we do that, I need to set you up with a few different trading platforms that you're going to need in order to start taking trades for yourself so you can start your learning journey. The first thing that you're going to need is a broker. Without a broker, you can't take trades. So what is a broker? A broker is an entity or a company that is going to facilitate your trades. In other words, they will be the ones that take your trades for you. So you send your trades through to your broker, and they make sure that those trades actually happen inside of the markets. This could be by taking the other side of your trade or porting it through to a commercial bank that will take the trade for you. Now, you simply cannot trade without a broker. If you don't have a broker, you can't place trades. No one is going to fill those trades for you. So you need a broker 100% if you want to trade. A broker nowadays is not an individual person. It's just a big company. And everything is done completely online. So what you actually do is link a brokerage account to a trading platform, and then all you have to do is click buttons, and that's going to take your trades for you. There's none of this old school getting on the phone to your broker to get into and out of your trades. It's a lot easier than that nowadays. So if that's what you had in mind, don't worry. Now be warned, because picking your broker is a very big decision. Some brokers are terrible. It will take you ages to withdraw your money. The trading conditions you get will be terrible, and that is going to result in lost money and lost trades, which we do not want. When we're looking for a broker, we want a broker that gives us good customer service, fast withdrawals, and exceptional trading conditions. Now, I have a broker that I've been using for my entire trading career. There's a link to that in the description, but there are some others that I would recommend as well. I like IC Markets, Vantage Markets, and Oanda. And if you're based in the US, Oanda is probably the best choice for you. I've tried many different brokers, but those 3 seem to be the best that I've used. Now, brokers make money in 2 main ways, through spreads and through commissions. And why does it matter to you how brokers make money? Well, this is because the broker's spreads and commissions will directly affect you. Commission is money you'll be charged for getting into and out of trades. And spread is a small price discrepancy between where you want to buy and where your trade is actually filled, which means you will pretty much enter every trade with a small loss. This spread is money that the broker kind of skims off the top in return for actually opening your trade. So they're going to make a small amount of money on the spreads, and they'll also make a small amount of money per trade on commissions. The reason it's important for you to understand these terms is because spread will affect your entries and your exits, and commission obviously is just going to cost you money. So let's talk deeper about spreads. In the market, we have two different prices for getting into and out of trades. We have a bid price and we have an ask price. The bid price is the price at which a broker will sell an asset to you, and the ask price is the price of which a broker will ask for in order to sell the asset to you. Now, the bid price is always going to be a little bit lower than the ask price. So they will pretty much always overcharge you a little bit and undercut you a little bit when you want to sell the asset back, which is annoying, but it's just the cost of doing business. Now, the difference between the bid and the ask price is your spread. Usually it is very small, but it's large enough to cost you a little bit of money when you want to get into positions. Now, we'll talk a bit more about how spreads affect individual trades when we move over to the chart. But for now, just make sure that you're trading with a broker who offers competitive spreads so that it's not eating up all of the profit on your trades. If you use one of the three brokers I listed, you shouldn't have a problem with spreads at all. Now, some brokers will charge very small spreads in return for a commission, which means they will charge you a dollar amount for every time you open and close a trade. Generally, commissions will be reasonably small, and they shouldn't eat into your profits massively unless you're taking trades that are way too big for your account. Once again, if you use one of the brokers I've suggested to you, the commissions are very, very manageable. And now, before we get into a bit more of the technical jargon around brokerage and trading accounts, it's time to choose your trading account. There are two different types of trading account that you can choose from. There is a demo account and a live account. A demo account is basically a practice money account, where you will have a trading account with fake money in. You can trade this, make profit, or lose money, and it doesn't matter because the money is not real. But it's a great place to begin and a great place to practice and build your skill set without having to risk and lose real money in the process. A live account is what you would move on to once you've mastered demo. This is a real money account. You deposit money into the account, you trade with that money, the profits you make are yours, but the losses you make will also be yours. So I highly suggest you stick with demo for a good few months to master the strategies before you move on to live accounts. Okay, so now let's talk about some terminology related to brokerage accounts. The first is lot sizes. So a lot size simply refers to how big your trade is. Every trade we take is sized in lots, and they vary anywhere from 0.01 up to hundreds or thousands, though you probably won't be trading hundreds or thousands of lots for a very long time, if ever, because to do that, you will need millions or tens of millions of dollars. So the lots that you'll most likely be trading in your earlier days of trading will be between 0.01 and 1 lot. You need to make sure you're trading the right lot size for every trade you take, but you can do that using a lot size calculator, like the one on the screen here. There's also a link to this in the description. Basically, how this works is, once you found your trade, you work out how big your stop loss is going to be, how big your trading account is, and how much money you want to risk on the trade. Then you click this button and it will tell you exactly how many lots your trade should be. But as I say, it's going to be very low to begin with. Now, if the information on there regarding stop losses and risk percentages is confusing, don't worry, we're getting to that soon. Okay, so what is leverage? Now, when you're trading on a CFD account with a broker, pretty much every account will have leverage built into it. Leverage is basically money that a broker will lend you in order to open trades. Now, a one lot trade is equivalent to $100,000 in contracts, meaning you would need $100,000 just to open this position. And if price moved even 1 pip, you would lose a lot of the money and your trade would be closed. So in order to stop this problem, and in order to make sure you can trade without needing tens or hundreds of thousands of dollars, brokers provide leverage. Leverage will be a ratio of 1 to a specific number. So a 1 to 30 leverage trading account means you can open trades with 30 times the buying power of the capital in your account. 1 to 500 means you can open trades 500 times larger than the money you have available. Now this is completely pointless. I suggest you choose a broker account with 1 to 30 or 1 to 50 leverage because this will stop you from oversizing trades. Now, although leverage is practically borrowed money, don't worry, it's not like a loan, it's not like debt. It is automatically built into the trading accounts as a useful tool for you to use, Most accounts nowadays, especially on all the big brokers, have negative account protection. So if you do go crazy, massively oversize a trade and lose all the money in your trading account, you're not going to end up in loads of debt to a broker. Don't worry, they will just cut your trades off when things go bad to make sure that you don't go into the negative. So what is margin? Well, margin is directly connected to leverage. Leverage is how much buying power your account has in terms of that ratio. So 1 to 30 leverage means you have 30 times the buying power of your account balance. Margin is the money that you need available in order to open these positions. So for example, if you wanted to open a $30,000 trade with 1 to 30 leverage, your margin requirement would be $1,000. $1,000 times 30, $30,000. If you had a $30,000 position open and your account size dropped below $1,000, your trade would be closed because you wouldn't have enough margin to keep that trade open. So margin is pretty much collateral for holding open positions, and it can be way smaller than the trade you actually take because of the leverage that the broker provides to you. My advice with leverage and margin is just to make sure you don't oversize trades. Keep your risk small to around 0.5 to 1% of your account balance and trade with a leverage of 1 to 30 or 1 to 50, no higher. You don't need higher leverage, and if you follow those rules, your margin should never cause a problem. Now, if your margin does get out of hand, you will get what is called a margin call. Generally, you're just going to get a notification or an email telling you to put more money into your account or the trades will be closed. This only happens if you oversize trades, so if you follow my advice, you should never run into that sticky situation. So now it's time for you to open your first trading account. I highly suggest that you open a demo account first of all. So go over to the broker's website, set up an account with them, and then choose demo. If you choose live, you're going to lose hundreds or thousands of dollars. You may as well practice with fake money first, because right now, you don't have the skill to make money, I promise you. So congrats, you have your first trading account. But a broker is only half of the puzzle, because you can't actually send trades directly through a brokerage account. You need a trading platform to send your orders through to your broker. Now, the trading platform that I suggest to you, the most popular one in the trading space, has been for many, many years, is MetaTrader. There are two variations, MetaTrader 4 and MetaTrader 5. They're both very similar. It doesn't really matter which one you select. Most brokers allow both. I choose MetaTrader 5 because it's a bit nicer, more refined, and more modern, but both will work. They're both available as desktop apps and mobile apps. I'd say get the mobile apps for now. Easier, more refined, and actually I do the majority of my trading on the mobile app still, even after 8 years of trading. So once you have the app downloaded, you can go into there, you can log into your brokerage account using the credentials that they sent you when you set up your demo account with your broker. And here you have price charts, which we'll discuss soon, and you can actually take trades inside of this platform. So this is where the trading takes place. And now that you have a trading account and a brokerage account and a platform to actually send orders on, I think it's time that we talk about entry orders, stop loss orders, and take profit orders. So the first type of order that we need to talk about is the entry order. And this is what you use to get into positions once you've found a trade. Now, we'll talk about the strategy of finding trades very soon, but first of all, once you've found a position, this is what you need to know. So there are 5 different entry orders that we can use as traders to get into buy or sell, long or short positions in the market. The first is a market execution. This is probably the most common way to trade, and it is an immediate buy or sell in the market. So if you wanted to get in right this second, you would open your app, select market execution, click buy or sell, and you'd immediately be thrown into a buy or sell trade. The second order entry type is a buy stop. So a buy stop order is an order that goes above price, and when price trades into that level, it will trigger you into a buy, which means if the market goes up through your buy stop and then continues going up, you will be bought into the market and you will make a profit. Now, the opposite of this is a sell stop. This is an order that goes beneath price, and when the market trades into it, it triggers a sell trade or a short position. So you would place this below price. If price declines through the sell stop, it will trigger you into a sell and you'll profit from a price decline. The next type of order is a buy limit, similar to the buy stop, but it goes beneath price. So you would place a buy limit under price, and when the market falls down into that level, it will trigger you into a buy. So the idea is you want the price to come down to your buy limit level and then reverse, and you will make profit from that buy. Now, a sell limit is simply the opposite of that. It is a sell order placed above price, and when the market comes into that level, it sells you into the market and you will profit if the market then declines. So those are the 5 different ways to get into positions in the market. Now, once we're in, we need ways to get out. And as you know, we have to manage our risk, meaning we want to let our winners run and cut our losses short. Now we can actually use automatic orders to do both of these things so that we don't have to be constantly staring at the charts every time we run a trade. This is what makes trading passive and allows you to go and live your life around the charts instead of having to be staring at the computer screen 24/7. So the first is a stop loss order. So if you enter a buy at one level and the market goes down, you can place a stop loss order ahead of time that will automatically close your trade before your loss gets too big. So you can predefine how much money you would want to risk before you get into a position. And then if you're wrong on that trade, it will take you out without your loss getting out of hand. A take profit order is simply the opposite. It will automatically take your profits. So if you buy, your take profit is going to be somewhere above price. And once the market triggers that take profit level, your trade will automatically be closed for a profit. So you can actually cut your losses short and let your winners run automatically. You don't have to be around to actively manage the trade 24/7. Stop loss orders and take profit orders are crucial. They are completely essential for balancing your risk to reward and making sure you have a risk managed strategy that gives you an edge in the markets. We're going to talk about this in the strategy section very soon, and I'll show you how we use stop losses and take profits to build out our trading edge. So now you are ready to take your first trade. But a big question that might be on your mind is how much money do you actually need to trade? You might see that your demo accounts come with $10,000, $50,000, $100,000 or more. This is a lot of money, and most people don't have access to this. But unfortunately, if you want to make a living in trading, realistically, you need a minimum of $100,000 in trading capital. Anything less than this, and you'll be working too hard to make substandard returns. And the money you generate really won't be as much as you could just make working a job. So you are going to need $100,000 to $200,000, maybe even $500,000 if you want to make some serious money trading. But don't worry, because I know this is out of reach for 99% of people. Saving this kind of money is impossible. I wouldn't have been able to do it myself, as I'm sure the majority of you watching won't either. It is a large amount of money. But nowadays, we have an industry called proprietary trading firms. They've been around for quite a while, but in the past few years, they've really blown up and became very, very popular in the trading space. Now, a proprietary trading firm, also known as a prop firm, is just a company that has access to funds, and they will give you either simulated or real funds to trade with, and then you will trade with that money, make a return, and then you get to keep a specific percentage of the profits. Generally, the process with a prop firm is, number one, you prove that you can trade and make profit without losing loads of money. Number two, once you've done that, they give you access to a trading account. You then trade that account. And number three, providing that you make profit and you don't break their risk rules, they will pay you out generally around 70 to 80% of any of the profits that you make. These prop firms can give you massive buying power. Here's an account that I've got right now. This is $400,000 in simulated funds, but the profits I make on this account will be paid to me in real cash. Prop firm evaluations can be accessed anywhere from around $100 to $1,000. So you don't need to worry about having hundreds of thousands or millions of dollars to trade with. You can get access to this. And the best thing is it's risk-free. Don't rush into prop firms just yet though, because without the skill, they can become quite the money pit. All right, so you know the basics. You've got your trading account set up. You've got a broker, and you know that you need a good strategy if you want to become a winning trader. So now it's time to teach you about the charts. This is a price chart. And if you're going to be becoming a trader, you better get used to these because you're going to spend a lot of time looking at them, especially in the early days when you're studying and learning your strategy. So I am going to take you through the platform that we're using here, which is called TradingView. But first, I want to get you familiar with price charts and explain how they work and how we read them. So first of all, I've just marked off two things. First, up here in the corner, this is where our asset is. So when you're looking at a price chart, it's always going to be a price chart for a specific asset or currency pair. In this instance, we can see it is euro versus US dollar. So this is the euro USD currency pair. Now over to the right here, we have a price level. Okay, we have a price bar. And what we can see here is basically the price of an asset. Now where the gray box is exactly where price is right now. So what this chart shows us is that this market, Euro USD, is trading at 1.11765. Now this will fluctuate every couple of seconds, as you're going to see, because this is how markets move. There'll be small fluctuations in price. And this line here, all of this is the price reading. So when we're looking at a price chart, it is simply showing us the readings of price movements. So we can see right now the price is at 1.11764. But we could see when we were down at this level here, the market was trading at 1.11431, okay, just there. Now, that's all this line is. It is just a line that shows us what the price is at any given moment, and that will change accordingly. So So we get a big messy line just like this. Now this price chart is what we read when we are doing technical analysis. And technical analysis is going to be pretty core to your strategy and the main thing that you're focusing on in the early days compared to fundamental or macroeconomic analysis. Now, one interesting thing about this when we're looking at price charts, we are basically never going to be looking at line charts like the one you can see here on the screen. Instead, we will be looking at candlestick charts. So this that you can see here is a candlestick chart, and this is where we do our technical analysis. Now, the reason for this is when we're looking at a line chart, we don't really have much information. The only information that this chart gives us is what price is right now or what price has been in the past. But we can't actually see the buying and the selling, and we don't get any information from this chart except for the direct price. Now, when we're looking at a candlestick chart, each of these little blocks is called a candlestick, and each of these candlesticks gives us a significant amount of information as to who is in control, whether it's the buying or the selling that is taking control of the market. And we need to know this information because if the buyers are in control, we want to buy. And if the sellers are in control, then we want to sell. So now let's break down what a candlestick is. This is the anatomy of a candlestick. We have two candlesticks here. The candlestick on the left is a bullish candlestick, and the candlestick on the right is a bearish candlestick. Now, as we said in the terminology, bullish is the name we give to a market that is going up. Bearish is the name that we give to a market that is going down. So when we see a bullish candle, this is a candle that has closed higher than it opened. Now, a candle, one of these here, indicates price movements over a given time frame. Now, I'm going to explain time frames a bit more in depth, but we're going to call this the 1 hour candle for now, which means this candle is giving us 1 hour worth of price information. And every candle we look at will be showing us 1 hour of price action. Now, the candle is made up of two parts, a body, and then we also have wicks, which are these sticks that come off the candle, as you might recall seeing just a moment ago when I showed you the candlestick chart. A candlestick that is bullish has an open price that is lower than the close price. So the open price is the price level that the market was at the start of that specified time frame. So with this being the hourly, this would be at the start of 1 hour, price was trading at this level. For example, if we look over there to the price bar, 1.13166 would be the open price for this market. The close price is then where the market closed that specific time frame at, in this case 1 hour. So we can see once again, looking over here to the right, the price bar is showing a reading of 1.13848. So that means this bullish candle opened at this price level, pushed up throughout this hour, and closed at this price level. Now, a bearish candle would show the opposite. The open price is at the top of the candle. Then the candle moved down throughout the given time frame and closed lower. Now, generally, when you are trading with candlesticks, you will mark them as different colors. You can see the bullish candle here is blue, and the bearish candle here is gray. These are the colors I use because they're pretty, but it just differentiates which candles are bullish and which candles are bearish. Now, the candle body and the open and close price shows confirmed price movement within the given time frame. The wicks, so these little sticks up here and down at the bottom as well, these show rejected price action. So this is where we get a lot more information from these candlestick charts than we get from line charts. So basically, confirmed price action is the hour started here, the hour closed here. This is a confirmed price movement. The hour started here and it closed down here. So this is a confirmed price movement. So the body is showing confirmed price moves. But the market may, and pretty much always does, move further out of the bounds of the open and close price, meaning at some point within this specified hour, the market traded higher and it traded lower, but it only managed to close here. So this is what we see as wicks, and these wicks therefore show rejected price action. It shows a movement of where the market attempted to go higher. So at one point, the candlestick would have looked like this, but before the hour was up, the market came back down and closed here. So the wick is rejected price action. It also shows that the market at some point was bearish and attempted to go down to pretty much that level down there at the bottom of the wick. But before the hour was up, we had a price movement up, and obviously then we got the price move closing here. So the body is confirmed price action, the wicks are rejected. Now these candles and wicks show us different things. They show us the strength in buying and selling. So with this bearish candle, we see a market that the sellers were definitely in control because the market was able to move down from this price level to this price level. The rejected prices show us a bit more insight into what the market attempted to do. Now, the fact we have this wick up here shows us that the market did attempt to go higher. So much like what I just showed you, at one point this would have been a bullish candle, but eventually it came back down and rejected those higher prices. So when we're looking at the candles like this with wicks either side, we get a lot of information. It shows us the buyers attempted to go higher, but then they failed. And they attempted to go even lower, but then some buying must have commenced in the market, which kind of equalized the market and brought it back up a little bit so that it didn't close incredibly bearish. An important element to understanding these candlesticks is the concept of momentum and strength between buyers and sellers. So when we're looking at a chart, the market is basically a massive picture that is drawn showing us market psychology. When we have incredibly bullish candles, like a candle like this that has little to no wicks, especially at the top, this shows us that buyers are clearly in control. Now, when there is more buying than selling taking place, markets go up. And when there's more selling than buying taking place, markets move down. So to read momentum, we want to look at the candle bodies and the candle wicks. A strong candle body with little to no wicks like this shows strong momentum. So in this instance, where we have a bullish candle, where the open price is down here and the close price is all the way up here with little to no wicks, this shows uninterrupted buying. So we saw a massive influx of buyers driving the market up through that specified time frame. Now this obviously shows us buyers in control. That means the market is bullish. So we would therefore want to be buying. Now another thing that can show strength from buyers is the wicks. So let's say we have this market, which started out bearish, okay? So we have a candle where we've had a wick above, and then we've had a lot of selling pressure commencing inside of this market. The market's attempted to get considerably lower, pushing all the way down to here. But before the specified time frame, in this case 1 hour, is up, if the market pushed up and ended up closing like this would be an incredibly bullish sign. Because what it shows us is that although the market attempted to go considerably lower, we saw an influx of buyers down here, which drove the market all the way back up, not just to the open price, but higher to form a higher closing price. What this tells us is that somewhere within this price action, buyers have taken this market by storm and injected a massive amount of buying pressure into it, driving us all the way back up further than the price that we opened the time frame at. So if we see a candle like this with a very large wick, this is also a big indication of strong bullish momentum. Now the same goes the other way round. If we had a bullish candle that looked like this, but it ended up closing all the way down here, that would actually be a bearish signal, because we've seen at some point within this time frame up here, the sellers took control, and they not only drove the market back down to the open price, but they pushed it all the way into a considerably lower closing price. So with your new understanding of candlesticks and the momentum and the different characteristics of candlesticks along with the information they give us, now let's take a look at a chart, and I'll show you how we can read the price movements of a chart with the information we've got. So this is Euro USD. You can see the time frame here, okay, just there. It is the 1 hour time frame. Now we could change the interval, but we're going to keep it at the 1 hour time frame for the duration of this small trading. So each one of these candlesticks, meaning each of these little boxes, is showing 1 hour of price action, okay? So inside of each one of these candles, if we were to drop the time frame, we can drop through multiple different increments to the 15-minute, for example. Each one of these 1 hour candles, a 60-minute candle, would have 4 smaller candles within it, right? So you can actually trade in different ways. Now, let me just block one off real quick. We'll block off the latest candle. So we're gonna push that down. Now I'm going to drop to the 15-minute time frame. So if we go here, we go to 15, you can see that we have multiple smaller candles, okay? So we have 1, 2, 3, 4, 5, 6, because we have around an hour and a half of price action captured just there. Now, if we went even lower to the 5-minute time frame, you can see that the amount of candles triples once again, because we've now got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, okay? So there's more candles within each of the larger candles we look at. Now, we could also go up and look at a daily time frame. Now, everything we've just looked at is pretty much just going to dissolve into one individual candlestick, which is going to be the candlestick just here. Now, on the hourly time frame, we're going to have around 24 individual candles inside of each day, okay? Nice and simple. So with time frames out of the way then, let's have a look at the momentum that we've just discussed. So obviously, one of the core things we want to do when we're trading a market is work out if a market is bullish or bearish. If a market is bullish or going up, then we would want to buy. If a market is bearish and going down, we would want to sell. Markets will change quite a lot, but we can get different trends. We can see the different directions of the market across different time frames. I'm going to teach you a couple of concepts and a very basic strategy that you can start to practice with. But first of all, let's just look at some of the individual areas of candlesticks. So we discussed the concept of momentum. When we have strong candles with little to no wicks, we know that that market is either bullish or bearish. Now in this instance, we have many blue candles. You can see on these blue candles, we don't have many wicks at the top, okay? So wicks at the top, just like this one here, show some rejections. Wicks at the top here can indicate selling. But you can see that apart from this candle, we really have a lot of strong candles with very small or no wicks at the top. These candles are strong, they don't have many wicks. This is showing uninterrupted buying. So in a market like this one, we would be looking to buy. If we take a look at some of the downward price action, let's take a look at this area. Once we see some strong bearish candles, so we see these large sell candles with only little or no wicks underneath them, this is a market that is moving down. So this is a market of which we would want to sell, okay? It's going to be a bearish market. When we're in a market like that, our focus is on selling. Now there's a bit more to it than that because of course, as you can see, the selling didn't last forever. And as you can see, the buying didn't last forever. And we do need to find opportunities to buy or sell. We can't just guess our way into buys and sells. Eventually, each movement will come to an end. I'm going to show you two concepts very soon, which will help you to start understanding how we can work out which way the market's going, and then how we can start to get in and get out with a profit. But for now, just understanding this initial candle theory where we've got strong bullish candles and strong bearish candles, and we always want to buy when we see these bullish candles and we want to sell when we see these bearish candles is the first step to understanding things. So that is it. That is the first step into reading candlesticks. Okay, so as we said previously, one of the biggest things we want to do when we're trading a market is identify the direction. We need to know the trend. Now we have three phases. I briefly covered this earlier in the class. We have uptrends, downtrends, and consolidation. Now an uptrend is when a market is clearly going up. A consolidation is when it's going sideways, and a downtrend is when the market is going down. Through uptrends, we want to buy. This is where buying opportunities present themselves and where we make the most profit from long positions. In downtrends, we want to sell. This is where profit is made, going short in the market. Consolidation is pretty much just a place where money gets eaten. We want to practically avoid trading all consolidations. There are a few strategies you can use that I use myself, but it's a bit more advanced. So for now, we're going to focus on the trends. This is all you're going to need to really get started and make some money trading. Under this market structure theory, we are reading the market through highs and lows. So we are always looking for higher highs and higher lows in an uptrend. And in a downtrend, we are looking for lower lows and lower highs. I've marked on here HH and HL. This is higher high and higher low. Here is LH and LL. This is lower low and lower high. So focusing in on this uptrend first of all then, when we see a market that is forming higher highs and higher lows, we know that this is a buying scenario that we want to buy through. Now a higher high is literally just a high in the market printed in price that is higher than the previous high that was printed, okay? So every time we get a high form like this in a market, then we have this market pullback. When the market pushes through to a new high, we have a higher high and we have a validated previous higher high. So if the market is continually printing upward movements like this, we know that this is a buying scenario. And providing the market stays above the higher lows, it will remain a buying scenario until things change. So in the case of the downtrend, it's the opposite. Every low that the market prints is lower than the previous low. And every high that the market prints is also lower than the previous high. As long as that stays true, the market will continue to be a selling opportunity. So we only want to sell here and we only want to buy here. Now, eventually the market will shift. So let's focus in on this example here. Every time we form a lower high, this becomes an important point of structure. So we could mark these highs out like this. And basically, if this breaks, that will be a change in the trend. So to determine where a downtrend is ending and an uptrend is beginning, we would want to see price action like this, where the market stops forming lower lows and lower highs and breaks up to form a higher high. If we push up here and we form a higher high in this market, this is a market that has now changed direction. And instead of expecting to sell, we should now be interested in buying because we expect, following a higher high, that a higher low is going to form, which would be this price point here. And this realistically is where we as traders want to try and get into this market. The same is true for uptrends. So if we clear this consolidation from the chart real quick, we would see this higher low would be our interesting point of structure. And if the market continues to trade above this higher low, that's fine, we continue buying. But if the market breaks down and forms a lower low just here, this becomes a market of which we should now be looking to sell. We can anticipate that the market is going to form a lower high and continue trading into new lower lows. So this just here is the crossover point where we stop being bullish and we start being bearish. And we would then expect the market to move into a bearish phase like this. Now you understand the basics of price charts, let's talk about strategy. Now there are many different technical analysis methods you can use to analyze charts, but the best is price action. Many beginner traders focus instead on indicators, but there is a big problem with indicators, and that is that they lag and they show past information. Now, there are many different subsections of price action trading. What the best method is subjective and down to personal preference and the findings of each individual trader. But from my 8 years of experience and what I found works best for me, as well as the thousands of students who have used my systems to find success, I use, and I'm going to teach you, a set of concepts that I call logic-based concepts. And don't worry, for this class, we're going to keep it very simple, but I'm going to outline a strategy that you can use to start winning. So let's have a look at some of those concepts now. So remember I said, in order to make money, we need to be moving with the trend. Whether it's an uptrend or a downtrend, we need to know which way the market's going. Well, the best concept that we can use to do this and to make sure that we are always moving with the trend is market structure. Now we're going to take a look at a real market, and I'm going to break down that structure concept I just showed you, but in real time on a real price chart. So we're looking at Euro AUD, which is the euro versus the Australian dollar. We're looking at the hourly time frame, just keeping it relevant to everything we've covered so far. We're going to start by drawing the trend. Now, if we take a look initially at this phase, from this low up to this high, we can see that this is evidently an uptrend. So let's mark this out using the higher high, higher low format. So we have initially our low in the market, which is here. From there, we have this push up and we form this high. The market then comes up and forms a lower low at this level just here. And then we get a push up to form a new higher high. Then we pull back, we form a higher low, and we continue to do this all the way through this trending move, okay? So every time the market pushes up and forms a new higher high, and then forms a new lower low, we basically validate a continuation of the trend, which means we should expect the market to continue moving up. Now, we would then look for opportunities to buy throughout this uptrend. Now, obviously for entries, for actual opportunities to get into trades, we're going to need new concepts, which I'm going to teach you very soon. But you would only be looking to buy while the market is continually forming these highs, higher highs and higher lows, okay? Now, then we push up into this second phase, this area here. This is what we call the consolidation. So you can see at this point, the market is not really making any movements. It's just going sideways. Then we have a pull down lower, and this is where we begin a new downtrend. So as we can see, the higher low that we should keep in mind is going to be this one just here. This is the final higher low in this uptrend. So to draw it out, we can pretty much simplify this to, we've got this high, we've got this higher low, we've got a higher high, we've got a higher low, higher high, higher low, and then we have this higher high, higher low, higher high, okay? That is the simplified structure. Now you can see it's messier in person than it is in the trading examples, which is why I'm showing you this. Then we move into consolidation, where the market doesn't form any new highs or any new lows. We do this for quite some time, to be honest. As you can see all the way through this price move as well, we pretty much are just consolidating at this point. Now, there would be opportunity for trades on some of the lower time frames, like the 15-minute, the 30-minute, the 10-minute, but on this hourly, we are just consolidating, okay? When the market then reaches this level, just here, we shift into a downtrend. So we've actually stopped forming higher highs and higher lows, and instead we've now ended the consolidation with a break to the downside. So because we formed a lower low here, we would then anticipate the same formation the other way. We have a lower high. Then we come down and we form a lower low. Then we form this lower high. Then we form this lower low. Then we have a lower high once again at this level, and then we continue to creep down in this lower low, lower high format, okay? So that is how we identify trends. Now, as I've said, it is a lot less neat in real time than it is when you are taking a look at an example, right? But you need to understand that it is very simple in reality. Even if a market is messy, we're always just going to be looking for where those highs and those lows in the market are printed. And wherever the low forms, the meaningful low in an uptrend, you want to buy above that level. And when it breaks, that is when you start shifting into this lower low, lower high format, which provides selling opportunities, much like what we've seen here. So in line with those examples I showed you before, we have this uptrend, we have a consolidation, and then we have a downtrend. As we have said, we want to buy through uptrends. We want to stay out during consolidation, so take no trades through this unless we're working with lower timeframes, which as a beginner, I would suggest you don't do. And then in the downtrend, we would look for selling opportunities or shorts. So uptrends for longs, downtrends for shorts, consolidations for just taking a day off. Once you've worked out which way the market's going, by identifying the trend using those market structure concepts, you obviously need to find places to get in and out of the markets. And this is where supply and demand comes in. Now, let me quickly explain the theory behind this. It's very interesting and it's also very important. So market structure is excellent for working out the direction of trades. We want to buy in uptrends, sell in downtrends. But now we have to actually find opportunity to get into positions. And this is where supply and demand theory comes in. So with this simple concept, supply and demand, paired with market structure, you will have a simple trading strategy that you can start to apply. Now, to explain the theory of supply and demand then, when we have an upward trending market like this, the market is going to form consolidation areas within. This is known as a demand zone. Now I'm going to show you what this looks like on a chart in just one moment and how to plot it. But basically the market is going to stall out and then continue moving. The same happens in a downtrend. The market during its downward moves will stall out at some point before it continues selling. And that is going to form a supply zone, okay? So supply and demand is basically referring to zones in the market. And basically how it works is an auction theory. When we see a place in the market where price is stalled out before a large rally, it shows us buyers happy to buy at this level, okay? And if we see the same on the selling side, it simply means sellers are happy to sell at this price level. Now, if we think about what a price chart shows us, it is showing us the price of an asset, right? This price bar here shows us the price of an asset. So in this example of the supply then, if we'd seen the market stall out here and then continue to push down into a large selling phase from this price area, this would be around 1.70900 to 1.70500. That price range just there is seen as a price area or a range in price that sellers were happy to sell at. Now, the reason we know that is because the market's driven by selling and buying, right? Which means if we've seen a large, fast selling movement coming from an area of consolidation or sideways price action, supply zone, that shows us that a lot of selling took place at that level. Now, the concept then is, if the market's now pretty cheap, it's not going to be a good level for people to sell at. Traders would want to see a premium price to sell from, so they'd be looking for a pullback towards an area that was previously seen as a premium. When the market pulls back and trades into this premium price area, that is therefore going to be an area where selling will take place again, simply because if people saw this as a premium before, they are going to see it as a premium now when the market is even cheaper. Take a look at that from a buying perspective. If the market pulls back to a demand, this is seen as a discount. Let's say you wanted to buy a car and it was a reasonable price and you were happy to buy it, but you didn't. Then the price of that car goes up dramatically. Well, then if the price of that car comes back down to a reasonable level where it was previously that you already saw as a reasonable price, you're going to buy that car, or you're more likely to do that than you would be if you were buying at a premium. So this is the theory of supply and demand. When there is demand for an asset, the market is going to continue to go up, and demand comes in at these favorable discount price levels. The same happens with supply. Supply of an asset will enter a market as people sell into the market when the market gets to a premium price point. And this, supply and demand, is exactly how we are going to get into trades. So that's a solid beginner strategy for you to use. But in order to do your analysis, you need to have an account with tradingview.com so you can access this charting software. For the next couple minutes, I'm just going to introduce you to this platform. I'm not sponsored, but it's pretty much what every trader uses nowadays, including myself. I've used it a very long time. Competition does not exist. It's just so good. So tradingview.com, you need to go there, make an account. I believe they have free accounts. They also have paid accounts. You only need a cheap one if you are going to get into this seriously. You don't need the super expensive packages to begin with. This is a platform simply for charting. Okay, so this is where we do our technical analysis. I'm going to show you how to set it up and how it works so that you can go and do this for yourself in a short while. So we've got, first of all, your asset. This is where you choose the asset that you want to trade. You can type in any asset here, Euro USD. That's going to take you to a Euro USD chart. Here's a trade I'm in right now. Then we could go to GBP USD. This is going to take you to the pound versus the US dollar. You could type in anything, right? Gold, XAU USD. That's going to take you to the gold chart. Now, past that, we go on to timeframes. You can highlight timeframes that you like to use quite often. This example here, I've got my 1 minute, 2 minute, 5 minute, 10 minute, 30, 1 hour, 4 hour, daily, weekly, monthly. So I've actually probably got too many highlighted that I don't particularly use these on every single trade I'm looking at, but it's always just good to have them there. Now, when you choose a time frame, it's going to take you to the chart for that time frame, right? So the 4 hour time frame here, you can see this is kind of a zoomed out look where we have less candles and a more averaged out picture. If we go to the 1 hour, we see we're actually looking at the same information, but broken down. There's now 4 candles for every 1 candle on the hourly time frame. We go to the weekly, things completely change because obviously on the weekly, we are looking at significantly different price action, right? Now, once you've done that, you've got your asset and your time frame, you could start doing analysis. Now, first things first, we also want to make sure we're on the candle chart. So you can favorite that. I'm going to favorite that now. You don't need line. You don't need none of this drama. It's all very weird. Candles, it's just nice and simple. Now, if you want to customize the way your candlestick chart looks, you can just double click the candles. Then you have canvas and you can change the colors. Okay, you can pick any colors you want to make up the chart so that you've got specific colors that you want personalized to you. I use this blue and this gray. There they are if you want to copy mine. I know a lot of people do use this one after watching my videos. Once you've got your chart set up how you want it, now we need to move over to these tools. So when you're doing your analysis, as we've just done, you're going to be focusing on market structure and supply and demand. So for this, we just really need the trend line tool. That is this tool just here. I wouldn't recommend using it for trend lines because trend line trading is not a great way to trade. You know, head and shoulders, chart patterns, trend lines, wedges, triangles. I would avoid all of that stuff, okay? But you can use this trend line tool to mark out structure. So once you've got your trend line tool, you would just use it to mark highs and lows in the market. When the market forms a new high, that's going to be your higher high. You can mark that with a line. When that breaks again, that's going to validate you either want to buy, or for example, if the market breaks a lower low, you would know then you want to start selling, okay? So that's one tool that you're going to need is the trend line tool. Past that, to mark supply and demand zones, you want to use this little rectangle tool, nice and simple. You just then find your areas of supply or demand, mark them on the chart using this rectangle tool. That's going to line you up with your demand, right? So from this analysis, we would have our break of structure there. Because the market broke structure, we could place our demand. If the market comes back to this level, we might want to buy here, okay? So we could be looking for the market to pull back and then continue trading higher. Realistically, the only tools you're actually going to need right now are these, the trend line tool and the rectangle tool. You don't actually need the majority of the rest. You could use this path tool just to kind of forecast things. But aside from the structure and supply and demand, that's where you're beginning now, this is all you need. And I want to tell you now, you really do not need none of these indicators. I use this one for sessions, which shows us different times of day to trade at. But that's the only thing I use, right? So you're going to see, if you're getting into trading, you're probably going to get a lot of BS information about things like Bollinger Bands, RSIs, MACDs. You don't need none of that stuff, okay? It is counterproductive. It will keep you losing for a while. Focus on the price action like I've taught you. Now, the only other thing you're then going to need is your trade setup tool. So if we click on this tab just here, we have long position and short position. These are the only things we really need. Going back to this idea, if we wanted to buy here, we can use this to work out how big our stop loss is and things like that. Then we can use a risk calculator like the MyFXbook one to work out how much we want to risk on a trade, right? So if we wanted to risk $100 on this trade, we could mark this up. Now this 76.742 tells us this is a 76 pips stop loss. So then we would go onto our calculator, we would type in 76 pips, $100 risk, and then it would tell us exactly what size our trade should be. Then we can use that to place our trade. And then of course, as we can see with the 9.66, that's showing us how much of a return we'll make. So for a trade like this, we know we were going to make $9.66 for every $1 we risk if this trade wins, right? So if we risk $100, this would make just under $1,000 back in return if the trade won. And if it loses, we lose $100. But that's it. Long position and the short position tool, both completely the same. You just amend those to wherever you find your trades using market structure, which we can mark with this trendline tool, and supply and demand, which we can mark with this rectangle tool. You can favorite all those as well if you want to, and they go on a favorites bar like this. And past that, that's everything you're going to need. So that is how you set up TradingView. That's the chart platform I highly suggest you start to use so that you can do some practice work. So now I've taught you all of the basics, but there is still a lot more to learn. There are a few ways we can do this. First is a free course that I have. This is going to help you to build your first trading system, simplify trading from day one so you can improve your trades before you even begin and find success in trading. There is a link at the top of the description for this. The second way is in my full trading academy, which is a fully fledged complete educational program. I have live calls and classes, a global community, and a massive course for you to go through, where I teach you the frameworks and systems that get me results like this on a yearly basis, and got my students results like these. These are all real money results, profits made by students using the systems that I've taught them. And alongside the learning, you can make money as well. This is a trade call that I recently